Welcome to The Explainer. Today, we're tackling one of the biggest financial stories of the year. India has totally ripped up its old income tax law and started fresh for 2025. So what does this mean for your money? Let's get into it. Okay, let's just process this for a second. The Income Tax Act of 1961, a law that's been around for over 6 decades, is officially out the door. It's been replaced, top to bottom, with a new act. This is a truly historic shift in how the country handles taxes. And look, this isn't just some minor update. The new act was really designed from scratch to be modern and way more streamlined. The whole idea was to get away from that old, tangled mess of a law. We're talking about going down to 536 sections in 23 chapters. It's just a lot shorter and hopefully much easier for everyone to understand.
Right. So let's get to the question that's on everybody's mind. What does this actually do for your bank account? How does it affect your wallet? Well, the changes here, they're pretty big.
The first thing you need to know is this number right here, 12 lakh rupees. This is the new base income that's totally tax-free. It's a huge change, and it's going to affect pretty much every single taxpayer out there.
But wait, it actually gets better. On top of that 12 lakh, the government has also bumped up the standard deduction for all you salaried folks to 75,000 rupees. And when you put those two numbers together, you get the real magic number. And there you have it, 12 lakh, 75,000 rupees. For millions of people, this is the new reality. Because of an updated rebate in the new law, if your total income is up to this amount, your tax bill could literally be zero. That's your new effective tax-free income.
So what happens if you earn more than that? Well, the government's brought in a whole new tax slab system that's way more gradual. Instead of these big, sudden jumps in your tax rate, it now climbs up in these smaller, steadier steps, starting at 5% and going up to 30%. The goal is obviously to make it a much smoother ride as your income increases.
All right, let's move on and look at how this whole thing actually changes the system itself, because this goes way beyond just the numbers on your tax forms. We're talking about a whole new administrative backbone.
First things first, say goodbye to all that confusion. You know how we used to have a previous year for earning and then an assessment year for filing? That's gone. Now it's just one single, simple tax year. It sounds like a small language change, but trust me, it's a huge step toward making things easier for everyone.
Another massive change? The whole assessment process is now digital and faceless. This is a really big deal. By taking out a lot of the direct human-to-human contact, the system's designed to be way more transparent, faster, and, this is a big one, to cut down on the chances for corruption. And to make sure the tax system can keep up with the times, the Central Board of Direct Taxes, the CBDT, has been given more power. This basically lets them create and change tax rules more quickly so they don't have to pass a whole new law for every little tweak. It makes the system much more agile.
Okay, so what does all this mean for you, practically speaking? Let's break down the new rules you actually need to know about when you're filing your taxes and managing your money.
So if you're sending money overseas, listen up. The limit for when tax collected at source, or TCS, kicks in has been raised. It used to be 7 lakh, now it's 10 lakh rupees. That gives you a little more breathing room before that tax gets applied. The new law also brings in a bunch of other changes to make life easier. If you realize you made a mistake on your return, you now have a massive 48-month window to file an updated one. For all the entrepreneurs out there, tax breaks for startups and IFSC units are now locked in until 2030. And they've gotten rid of some rules altogether, like the TCS on big purchases of goods and on foreign money transfers for education loans. So the new law also finally catches up with the modern economy. It brings some much-needed clarity to things like crypto and other assets that have been stuck in a weird legal limbo for years. And that brings us to the question so many of you have been asking. With everything going digital, how in the world does this new tax law handle things like cryptocurrencies and other virtual assets? Okay, this is absolutely critical for anyone in the crypto world. Virtual digital assets, or VDAs, which means your crypto, your NFTs, all that stuff, are now officially classified as undisclosed income. So what does that really mean? It means the government's default position is that it's undisclosed, and the burden of proof is now entirely on you to declare it. It's a huge signal of a much tighter regulatory grip. And hey, it's not just about crypto. The new act does a ton of housekeeping, clearing up these confusing gray areas that have tripped people up for years. If you own property, there are now clearer rules on deductions for rent and even for empty commercial properties. And for retirees, the rules around pensions have also been spelled out, which gets rid of a lot of the old guesswork. So to wrap it all up, this is a massive overhaul. We're talking about replacing a 60-year-old law, creating a tax-free income level of nearly 13 lakh for a lot of people, and streamlining the whole system with things like a single tax year and faceless assessments. And on top of all that, the rules have finally caught up with the modern digital world. And that leaves us with one final thought. The goal here was pretty clear: a simpler, more transparent system that gives people real tax relief. The new framework is all set up, so now the question is, for you to think about, is this the modern tax reform that India really needed to move forward? Thanks for watching The Explainer.